Hello, welcome to this session of Ask Me Anything Thursday, only recorded here on LinkedIn. So thank you for logging in. Today, we didn't have any questions asked by viewers. However, one of the most questions I always been asked by buyers is whether or not they should get mortgage insurance, which is a property. So as you know, being a self-employed is good to have lots of contact and work with people who we trust, you like and trust. So who else I can invite to answer? Too bad I can invite to answer this question other than a prominent Vancouver financial planner, Lexx, who is going to help us answer this question. And if you have any questions for him thereafter, feel free to reach out. His contact information is right below. And don't forget to subscribe, ask any questions in private for next week, Ask Me Anything. So I'll pass it on to Lexx to help us answer this question about mortgage insurance or anything else to do with mortgage. Himself or his company can help buyers out there, whether they are looking now or consider the next few weeks or few months. So take it away, Lexx.
Thank you, Michael. What I'd like to do is to share this screen with you and discuss the differences between mortgage insurance when you purchase it from your mortgage lender and or getting individual insurance. To get straight to the point, it is always best to have your own than have someone else's. And essentially, when you sign up or tick the box to pay your mortgage with mortgage insurance from your lender, you're actually signing up for insurance for them. So the first thing you need to know is that if something ever happens when you have mortgage insurance from your lender, the lender receives the money, and all they receive is the amount of the mortgage. It is no more, no less. If you have personal insurance, it goes to your family. What is the coverage like? Well, typically, when you buy mortgage insurance from your lender, it only covers the amount of the mortgage. And important to understand is that over the years, as your principal decreases, the payout decreases commensurately to the amount that is left, the principal. However, you're paying the premium based on the original. So for example, if you have $1 million mortgage, you're going to be paying typically, or around right now, for a 40-year-old non-smoking male, $1 million of coverage for term insurance is probably about $53, $55 a month. 10 years from now, when your mortgage is down significantly, if you are paying that amount to the bank, your principal would have been reduced, but you're still paying the same $53. So it's important to understand that it's only the principal that's being insured, not the amount. If you bought personal insurance at $1 million, 10 years from now, you still have a coverage of $1 million. You have to think about what happens with your choice. Since the mortgage insurance is tied to the mortgage, at the end of the term, if you wanted to go and move to another institution, you'd have to go and requalify with the other institution for that coverage. So the coverage that you have with your current mortgage would not be portable. Whereas if you had your own, it doesn't matter where your mortgage is held. You have, in case something happens, your family would be receiving the full amount of the coverage. This is all about your choices.
Yes, so to understand this in the lame term is the choices we make today is going to affect in 5 years or 10 years from now. And $50, it's might not seem a lot for peace of mind, but it's a lot of money when you think about over time. And what can you do to those money? Maybe put in savings, put in some investment vehicle where money can grow.
That is absolutely correct, Michael.
Thank
Now,
you very
much. This can go into a lot more detail, but essentially understand that when you buy mortgage insurance, you should think of mortgage insurance as your life insurance, with the expectation that a portion of the proceeds, should something happen, would go to paying off the mortgage, and the rest would go to your family to do what they choose to do with it. Mm-hmm. And essentially, another thing that's important is that unless you somehow have a way of doubling up, the only way to have coverage on both people is to have individual life insurance on both spouses. So if anything happens to either one, the other spouse and the family is well cared for.
Yeah, it's very important to have that peace of mind. And buyers, especially the first-time buyers, have lots of choices to make. And when it comes to mortgage insurance, it's one of the last things you have to kind of put a check mark. However, people don't think how much detriment that will be, a few years from now. And it's good to good education, good information to have for buyers out there. Let's to close up. Question about mortgages. There's different financial institutions out there providing lending.
Yes.
Can you describe a bit your company provides in terms of mortgages?
Put it simply, at Canada Life, we can do anything a bank can do, but we can do things that banks can't do as well. Okay. So if you want to get a mortgage from us, we have very competitive rates. We also offer something called an all-in-one account, which is not the topic of today's conversation, but it's something that you can't get from a bank, but you can get from us. And it is a strategy for paying down your mortgage faster. However, it's not for everyone. It's for people who have discipline.
So how many people are disciplined, and what percentage of people get mortgage insurance from you? To kind of give a perspective out there.
Well, fact of the matter is, most people don't know any better, and they just tick the box when they go when they go to the bank to get a mortgage. Most people don't know that they can call their financial advisor and ask him to help them with their mortgage. Those two pieces of information puts you in a much better negotiating position when you want to talk about your mortgage. And if your financial advisor is working with you in a bunch of other things, you're bound to get a more aggressive rate from his institution than from the bank, who's going to perhaps offer you whatever their going rate is.
Good. Well, thank you so much, Lexx, for being a guest on this show. Only available on LinkedIn. Again, to viewers out there, please subscribe or send me a message for next week. Ask me anything. And any questions for Lexx or any further details about different products or insurance packages he's offering and he mentioned in this talk, reach out to him. His contact information is right below. Again, I'm Michael Tudori, Remax Select Properties, and this is Lexx Potter with Freedom 55. So thanks so much for watching.
Thank you very much, Michael.